Welcome back to the Phuble podcast. This podcast, of course, is sponsored by Phuble, the social networking platform for any and all investors. I didn't have the chance to publish a podcast last week, so I think I'm going to do two this week. I know it's the middle of the week, so I'm going to cover a few things from last week and some things from this week that have already happened. I'll probably do another podcast Friday as well, just to wrap up the entire week. So, big week last week for all the major indices. There was a big market plunge, actually. The Dow, I believe, was down over 1% or 1.5%, I think, sometime last week. I think 2 weeks ago, the Dow was at around 27,100, 27,200, I think. Last week, it plunged all the way down to 25,500, I think, at one point in time. That's a huge drop. That's over a 1,500 point drop. I think it was just a market correction. It bounced back this week. It's up at 26,000 right now at the middle of this week. It was just a market correction, but that really makes me nervous. S&P and NASDAQ also dropped. S&P is currently at 2,883 and NASDAQ is at 7,862. They also had major drops. The same time the Dow had a drop last week. Like I said, probably just market correction. There are economic declines and slowdowns happening all over the world, but I think the U.S. is still fine. It makes me nervous. I think it's going to hit the U.S. very soon, probably before the end of this year, where we do get a major economic slowdown. But right now, I expect those indices to bounce back up for the time being, and they have done so in part this week. They're not quite where they were 2 weeks ago, but they're still bouncing back. Big news on the Fed. Fed cut interest rates, I think 0.25%. The Fed cut interest rates 25 basis points, which is 0.25%. Down to 2.25%. I think their inflationary target it's historically always been around 2%. So probably they're going to cut again the next meeting, which is coming up in the next few months. But they're way too linked to the stock market right now and the presidency in the United States, which worries me a lot. They should be cutting because they think that the economy is slowing down, not because Donald Trump wants the Fed to cut, or not because they think the market has priced in a Fed cut rate. Moving on to earnings. There was a lot of earnings last week. I'm only going to cover one, I think, from last week, and that is General Electric. GE posted earnings at 17 cents per share, which was above the 12 cents per share that was predicted. Reported revenue of $28.83 billion. Which was above the forecast at $28.68 billion. GE has a lot of problems. They've had a lot of issues with their revenue growth and their free cash flow. They're anticipating their industrial free cash flow to be up $1 billion. Their current free cash flow is at negative $1 billion. I wouldn't touch GE with a 10-foot long pole. I wouldn't. They've just been declining over the past 2 years, like I mentioned, and it's just nothing looks good for them. I mean, the past year they've been floating between like $8 and $12. So I wouldn't mess with GE, even though they beat. They still have a lot to prove, especially with their power unit. Okay, moving on to Zillow. Zillow reported earnings. Shares fell for Zillow after they reported today after hours because they forecast that their home flipping business will lose about $80 million in the third quarter, which is the next quarter. They had good earnings this quarter for Q2. So their second quarter revenues were about $600 million. 69,000 homeowners requested an offer from Zillow to purchase their homes, which is up about 94% from Q1. They have a good business model. Their mortgages revenue rose 40% to $26.9 million. Zillow is an app where users can go on and buy homes. I think they also rent homes and apartments and sell homes to the company. They make, I think, about $1,500 on every single home that they buy and then resell, which is actually a pretty good margin. And if they can manage to expand into more markets, they'll be a fantastic business. The company lost $72 million this quarter. The Zillow offers segment hit about $250 million this quarter, which is really impressive, actually. Just buying homes and then flipping them and selling them again. It's a good business model. The issue is, though, if there is an economic slowdown in the U.S., they're going to be fine buying. They'll be able to buy homes very cheap, but then selling them, that's the issue. In an economic recession, they could still make a nice profit off of flipping homes. Their stock is at $49.75. It has gone up a lot, almost 60% since the beginning of the year. Market cap's at $10 billion, which it's not unreasonable. I know they lost $72 million, I think, this last quarter, but they're earning close to $600 million per quarter. So if they can just manage to really expand their markets, then they'll be okay. Zillow beat estimates. Revenue, like I mentioned, was $600 million and a loss of 14 cents per share. But it was predicted that they would only have $585 million in revenue and 15 cents loss per share. Apple's in the news because they are incurring a lawsuit for employees listening to information of users on Siri without the users actually saying, "Hey Siri." I think the lawsuit was just filed today, I think. The lawsuit's asking for $5,000 in damages per violation and to prevent all unauthorized recordings in the future, as well as delete all existing recordings that were unauthorized. Apple has suspended their Siri evaluation process, which allows employees to listen to conversations. I mean, it's not going to affect the stock. That's predicted that something like that would happen. They have to gain information on the users, and then, I mean, it is an invasion of privacy. I believe they had that in their privacy policy, that they would listen to owners of iPhones even without the owner saying, "Hey Siri," or it was ambiguous about how the process would be played out. So it's going to take a while to actually get through the courts. Apple is at $199.04. They're going to break $200 probably tomorrow. They already were above 200 last week, and then the whole market went down, but they're going to rise. They'll be positive finishing out the year, probably above 220. They're a great company. People really doubted them after they started to lose revenue on their products, on the product side of their business, but their service side is growing. Okay, Roku reported earnings today, and their shares were up 8% in after hours trading. They reported revenue of $250 million, and analysts had the revenue tracked at $224 million. They expect revenue to be $255 million in the third quarter. And for the full year, they expect revenue of $1.075 billion to $1.095 billion. Forecasts were expected at $1.03 billion to $1.05 billion. So the company reported a net loss of $9.33 million or 8 cents a share. Roku is on fire. Roku is a stock that is on fire. They rose about 12% after hours. 13% after hours. Roku, after they reported, is now at 113. They're a good company. They're going to probably get bought out by like a Netflix, I think. Someone that can pair with them. They're doing really well with their earnings. They're a good company. Just overall, they're a good company. I'd probably invest in them, even though they've had an absolutely insane run. Yeah, so Roku started the year at around $30, and they're going to go up even higher if someone buys them out. And someone will probably buy out Roku, I think. Someone who can use them. So Roku has about 31.5 million users, and they earn about $21, I think, per user, which is really good. So they had a loss of 8 cents per share, but their revenues beat estimates at $250 million. They're a good company. They're going to get bought out probably. I would invest in Roku. Okay, last one on this midweek rundown is Disney. Disney shares plunged when they released. They released their fiscal third quarter earnings report. The stock lost 5% after hours. Disney reported earnings of $1.35 on $20.25 billion in revenue, which was below expectations on Wall Street, which were $1.75 per share and $21.47 billion in revenue. Direct-to-consumer segment saw revenue of $3.83 billion during the third quarter, and operating losses increased. $168 million of that loss was due to their Disney Plus streaming service and their ESPN Plus service, which is their on-demand ESPN app. Bob Iger, the CEO, blamed the acquisition of most of the 21st Century Fox assets as weighing down their revenue. Also, weak theme park attendance. They have a lot. They recently bought 21st Century Fox. They also have Hulu. They're releasing their Disney Plus streaming service, and they also have ESPN Plus, which is their on-demand sports application. I would not invest in Disney. Going into streaming is difficult. It is. There's a huge learning curve that people don't think about before they go in. Also, acquiring another company is very difficult. They're going to have increased losses from Fox in the fourth quarter, and Bob Iger said that on the earnings call. They also are going to have increased costs for the streaming service. It's going to take a lot for them to get that up. Honestly, they probably should have just stayed on Netflix. I don't know how much profit they're going to earn from that streaming service. Their huge revenue driver in the past has always been their theme park attendance, and if that's declining too, that's going to be an issue for them. I would not invest in Disney. I think they're a good company, but they just have too much. They should definitely have waited to start the streaming service. I know they wanted to jump into it, but they should have just stayed with Netflix for the time being until they really figured out their merger or acquisition with 21st Century Fox. Because, I mean, you just have people from two different companies, two different large companies coming together, and it takes a while for them to actually absorb the same culture. I wouldn't invest in them. They're going to drop. They'll probably be below 130, I think, by the end of the year. They're at 134.86 right now. Market cap at 242.71 billion. PE ratio at 18. It's a low PE ratio for Disney, but I still wouldn't invest in them now. I would wait probably until like the middle of next year, once they figure everything out and they get over that learning curve with the streaming service, with the acquisition of Fox. Also, they need to figure out ESPN too, because ESPN has historically weighed on Disney profits. I don't know. I don't like Disney right now. Definitely can wait. They have a huge uphill battle with all of their business units. All right, guys. Thank you for watching the Phuble Podcast. It is Wednesday, August 7th, 2019. Just a midweek kind of roundup. And I will try to get another podcast out this week since I didn't push one out last week. Thank you again for watching. We're going to release the Phuble app very soon, so I'll keep you updated on that. And happy investing.